A balance sheet is a financial statement that shows a company's financial health at a specific point of time. It lists a company's assets, liabilities, and equity. A balance sheet is a financial statement that shows a business assets, liabilities, and equity at a specific point in time. It's sometimes referred to as the statement of financial position. The balance sheet provides information about a business ability to meet its long-term financial obligation. It also gives insight into a business' internal and external performances, its past performance, and its future prospects. Purpose and uses of a balance sheet. The main purpose of the balance sheet is to inform interested third parties about the financial health or financial position of business at a particular point in time by showing them what the business owes, assets, how much it still owes, liabilities, and the capital invested in the business, equity. These third parties pay attention to the financial notes and Unit 12.3 Balance Sheet Preparation. The balance sheet shows the assets, liabilities, and equity of the business. The piece of information collected from consecutive periods of time are grouped together to be able to forecast the financial trends of business. Components of balance sheets. The equation in a balance sheet is asset equal liability plus equity. Such equations is classified into three broad categories, the value of which must be accounted for. Assets. Assets represents all the investments of a business, which include cash, accountant, receivable, inventory of goods, machinery, tools, equipment, facilities, and so forth. It is anything that a business owns which hold an amount of quantifiable value that could be liquidated and converted into cash. Assets can be further categorizing into the following. Current assets are things that the business expects to turn into cash within a year. Example, investments, inventory, and money owed by the business by customer. Non-current assets are things that the business expected to hold for more than a year. Example, include properties, equipment, and investments. Liabilities. Liabilities are things that business owes to other, such as supplier, banks, the government's employees, and other financial institutions. They can be broken down into two categories. Current liabilities. These are debts that must be paid within 1 year. Example, short-term loans and account payable and payroll taxes. The other one is non-current liabilities. These are debts that are due more than 1 year from now. Example, including long-term loans, bonds, and leases. And then the next is equity. Equity primarily refers to the net worth of a business, the amount of money left after selling all its assets after paying its liabilities. In addition, the equity of business consists of share capital plus retained earnings. By regarding the original formula used in the balance sheets, the equation for equity would be equity is equal assets minus liabilities. Balance sheet preparation. A balance sheet is a financial statement that shows a company's financial health at a specific point of time. It is a snapshot of the company's finances, showing what it owes assets, what it owes liabilities, and the value of the company equity. The purpose. The main purpose of balance sheet is to provide information to interested parties about the company's financial position. These parties include investors. Investors are the balance sheets that assess the company's financial strength and potential for future growth. Creditors. Creditors are the balance sheets that evaluate the company's ability to repay its debt. Management. Management uses the balance sheet to make a decision about the company's operations. Uses. It can be used for assess the company's liquidity. Liquidity is the company's ability to meet in a short obligation. A company with high liquidity is less likely to experience financial difficulties. Evaluate the company's solvency. Solvency is a company's ability to meet its long-term obligation. A company with high solvency, it is likely to go to bankrupt. Analyze the company's Profitability. Profitability is the company's ability to generate profits. A profitable company is more likely to be able to pay its debt and grow its business. Identify trends in the company's financial performance by analyzing the balance sheet over time. It is possible to identify trends in the company's financial performance. This information can be used to make predictions about the company's future financial performance. The balance sheet is one of the basic financial statements showing snapshots of the firm's position and health at a specific period. It's rather like an X-ray giving what a business owns, what it owes, and what's left to the owners. Assets are the things a company owns that have a monetary value. Think of it as their stuff, cash, inventory, buildings, equipments, even things like patents or trademarks. Current assets are the things that are expected to be converted into cash within a year. Cash, inventory, and money owed by the business by customer are all examples. These are termed non-current if they are comprised buildings, equipments, and long-term investments held for more than a year. Liabilities. Liabilities includes everything a business owes to others. This can include loans, account payables, salaries, and taxes. Think of them as a debt owns. These are the current liabilities if they occur within 1 year. That includes account payable, short-term loans, and etc. These are non-current liabilities, including these are incurred due to mortgages and bond payable in the long term. Equity. Equity refers to the owner's stakes in the business. It is a difference between assets and liabilities. In simple terms, it's owner's investments in the company. There are two parts of equity. Share capital, which is fundamentally the amount of invested by the shareholders, and retained earnings, which are the profit accumulated over the years rather than being distributed as dividends. Balance sheets. The balance sheet is always balanced because the total of the assets must equal to the liabilities plus equity. This makes the equation hold true. The balance sheet is a fundamental tool to many interested parties. Investors use it for determining the financial strength and future growth prospects of the business. Creditors use to determine the ability of the company to pay off its debt. Management uses to make decisions about its operation. We can also analyze the financial performance of a company by using the balance sheets. By analyzing this balance sheet for a number of years, we will be able to identify trends and predict the future financial performance.